this morning, our title is Capital Crisis, the Crisis of Capitalism, Opportunity or Threat. This is a title that I have been grappling with unwittingly for the last 6 months, having the fact that Michael Green and I launched our book, Philanthropy about 3 days after Lehman Brothers went bust. And so the first question that everyone has asked us every time we've promoted the book has been, doesn't this financial crisis render the entire subject moot? Isn't it all over? Isn't the idea that social entrepreneurs can change the world in partnership with the sort of risk capitalists that we were talking about, whether they be philanthropists or funds or big companies that are backing these ideas? Isn't it all over? This crisis has discredited capitalism. We're back to the age of big government. To set the panel up, there are just a couple of thoughts I'd like to throw out before we throw open to discussion. One is that I do think that this is a once-in-a-generation moment, that the day Lehman Brothers went bust will mark the start of a new paradigm. The old paradigm is over, and we are now in a process where, for the next few years, we're going to be having to rethink everything again from first principles to sort out the good ideas and from the bad ideas, and to come up with some new good ideas. And this is going to be a very, very difficult and confusing environment, a real test of the leadership of the world, and a real opportunity for new leaders to come through with new ideas. Michael Green and I both believe that actually philanthrocapitalism, as we call it, or social entrepreneurship, or creative capitalism, or whatever label we want to apply to it, is going to be one of the ideas that needs to come through even stronger as a leading idea in this new age, this new paradigm, than it was under the old paradigm. That ideas of, that we certainly don't want to throw financial innovation and capitalism out of the window, but that financial innovation and capitalism without a grounding in values and sustainability and in demonstrating a clear benefit to society as a whole, is going to be in trouble. And so the challenge is going to be to find a way to sell that message to the powers that be in this new era. And it's going to fall to many of you to demonstrate through your business models and your successes how this new model can work and can inspire much broader social change. That's my perspective. We have three fantastic panelists to give their perspective and hopefully to agree with me, but more likely to disagree with me. Unfortunately, David Blood of Generation Capital can't make it today. He's had a last-minute scheduling issue, which I never know what that's shorthand for. But anyway, in his place, we have Sam Moss, who is president of Grey Matters Capital, who I think in some ways, because he's not investing in Toyota as far as I know, may have more practical and useful insights than even David would have provided into some of these difficult questions that we're grappling with. So we're going to start with Sir Cohen, who has been an inspiration certainly to me as I've looked at this field over the years, and I think to many of you. Then Jan Piery of Shorebank, and then finally Sam. So about 7 minutes each to start off. I'll come back with a couple of questions, and then we'll throw it open to discussion. Ron.
Thank you. Do you mind if I speak from there?
No, sure, go ahead. You're harder to control over there, unfortunately.
That's
why. Well, since we have 2 Americans and 1 British person, we thought he maybe should get a little more time. So we're to keep this all balanced.
Thank you, Jan. So I'm delighted to be here with all of you again at the Skoll Forum. At a time when I think the social sector, or the third sector, however you like to call it, faces some very real issues. As Matthew has said, we find ourselves in a situation where we really have a perfect storm that is comparable only to the 30s, where we're going to see an increase in social need as a result of climbing unemployment, possibility of increasing house repossessions, general disruptions to people's lives. And this is coming at precisely the same time as government is forced to buttress its financial system, a financial system that has grown to be larger than anything anybody had expected, I think, in the 30s, financial systems which are sometimes a multiple of the size of gross national product, and the need to fund increasing equity injections into the financial system, the need to support those who are unemployed and dispossessed, means that government budgets are under tremendous pressure. And so you have this paradox that at a time when the social sector should be doing a lot more, government is in a position, in a way, to support it a lot less. And government's constraints are very real. I don't know if they've been addressed in some of the other sessions, but governments have to contend with the reactions of capital markets to their plans. You've already seen in today's headlines evidence of the fact that the UK, and Germany's already been in the same position, has not sold out the whole of a planned bond issue. And the fears of government is that they cannot manage to implement a New Deal, if you like, in inverted commas, if they don't have the financial resources, and they don't have the financial resources if capital markets don't trust them. And in order to maintain the trust of capital markets, they may have to constrain their expenditure on a reflation program. Now, what's particularly concerning about this is that governments over the last few years in many countries, and perhaps in particular in the UK, have been very supportive of social investment. Government here has created organizations like Future Builders and Unlimited with hundreds of millions of pounds going to them. It's had initiatives in the social enterprise area. It's constantly wrestling with the question of what it should support. But if we give up on government because of the pressures on government, we're going to find ourselves in very serious trouble. Already we are seeing evidence that the decline in the values of foundation portfolios are leading them to reduce their donations. I don't need to tell you that individuals are a lot more careful about what they do in terms of their personal expenditure, and they will do the same with regard to their social investing or their philanthropic contributions. And the question is, what does the social sector do in the face of this challenge? Well, the first part of the answer is we cannot give up on government. We're a nascent sector. We need government support. Government has to play a major enabling role in order for us to be able to do our work. If government does not continue to support tax incentives, for instance, for particular types of social investment, the community investment tax relief comes to mind here in the UK, similar to the new markets tax credit, Jan and Sam, in the United States. We've had an allocation so far of £40 million for a program that initially should have attracted £100 million or £200 million, as the Social Investment Task Force asked. We have to have a broadening of those incentives today. It suits government in the sense that if the investment is not forthcoming, then the cost to government is zero. Matching finance. Bridges Ventures, of which I am a founder and the chairman, got going initially because the government was prepared to match £20 million raised from the private sector for investment in social venture funds with £20 million of government money. Again, matching finance is a crucial aspect of what government has to do in this crisis. And finally, a social investment bank. The Unclaimed Assets Commission, which I also chair, has been negotiating with the government to get its support to take assets which have lain dormant in British banks for 15 years or more, which are hundreds of millions of pounds, and to devote £300 million of that to the creation of a social investment bank, which would be independent of government, although it would report to Parliament, and whose goal would be to connect the social sector to the capital markets and to develop the social sector through the provision of finance, through its own bond issues, which would have attached to them tax incentives of the kind that I have been describing, equity issues in the investments in organizations that are trying to set up scalable, sustainable models capable of achieving more effective results than straight philanthropy has been able to do over the years. That is the threat part. As for the opportunity, Matthew, I think the opportunity is for us to use our innovative skills, which have got us into the situation where today we are being noticed, and people attending this conference will, I'm sure, have got the same sense of dynamism in the sector over the last day or so that Jan Piery was telling me about. There is great energy and there's great innovation, and we have to use that energy and that innovation to define ways for government to postpone its own expenditure now in return for a commitment to pay by results. Now, one of the organizations I've been helping and have helped to found is called Social Finance. Some of you will have been at the session preceding this one, which Toby Eccles chaired. Social finance is a group of people who believe in the concept of the social investment bank. Chairman is Bernard Horn, who was the equivalent of Chief Operating Officer of NatWest. David Blood, who really wanted to be here today. There was a mix-up at the time when he agreed to come to speak. James Strachan, who is on the board of the Bank of England, was at Merrill Lynch. Peter Wheeler, Goldman Sachs, and previously Future Builders, come from both the voluntary and the financial sector. David Robinson, those of you who know community links in this country, Victoria Hornby, and Geraldine Peacock, who was head of the Charity Commission, are other members of the board. We have joined the dots on a social impact bond, which, Matthew, if I have time, I would like to describe briefly today. The concept of a social impact bond is this, and I'm going to use the example of reoffending to illustrate it. The concept is that you would issue a bond with community investment tax relief attached, so that you would have, say, a 5% offset against your income tax a year for each of 5 years for the duration of the bond, which is what community investment tax relief offers here in the UK. And you would have an agreement with government that, having raised 10 or 20 or 30 or more millions of pounds or dollars to address the issue of reoffending, that government would agree that as you work with organizations that are active in this area, government would pay on the basis of results a certain amount of money each year for each person that did not reoffend. If they don't reoffend for 1 year, they don't reoffend for 2 years, for 3 years, 4 years, 5 years. Sufficient amounts to repay the bond and to leave a margin so that the social organization that is using the money of the bond can scale itself up and improve its sustainability. This is one example of an initiative that plays to government's needs today. Government is postponing its expenditure on reoffending in return for paying a portion of the saving in the future. And so the opportunity for us is to innovate, to come up with practical ways of raising capital on the back of government commitments. Now, the role of the social sector is to do what markets and government are unable to do for the benefit of society. If we're given the tools, we will do the job. Thank you.
Jan.
I very much agree that we cannot give up on government, and I must say that I feel better sitting here this year than I would have last year with respect to the United States, because we do have a government now that is looking to innovate in the space. But for Americans in the audience will appreciate that we have not ever done anything on the scale that Sir Ronald is talking about in the UK. So it's very inspiring to start here, to think out of the box. I was reading yesterday something in a communication from one of the Skoll scholars which had a tagline of the best way to predict the future is to invent it. And that is what I think we're really doing here in these days. I've found myself already enormously moved by the kind of not only creativity and impact, which all of you are having, but also the moving to scale, because now we can track some 6 years, I believe, of Skoll scholars. And these organizations are not simply extending their outreach, they're also very much scaling up their impact. So I think that is what I draw on to take some optimism in the face of this very serious crisis. I want to say just a word about my context and then go on with just a few observations before we kick it open to an exchange in terms of questions. I have two perspectives. One comes from having represented the United States on the board of the World Bank for some 7.5 years during the Clinton administration. And that was at a time when microfinance was just beginning to gain traction, and the board, in fact, had a debate soon after I arrived about whether there was any reason for the World Bank to become involved in microfinance. It was seen at that time as something that was not a legitimate part of the domain of finance, but more belonged in a sense of development assistance. So, and that was not so many years ago. That's less than a decade ago. So if we look today at the size and the scope of the microfinance industry globally, we can see the emergence of a whole phenomenon and extension of the financial system that was not anticipated at that time and was not even credible at that time. So this which gives me confidence that we're likewise going to be able to innovate in ways in this crisis that are going to take us in new directions. The other perspective I have is as an executive at Shorebank Corporation, which is 35 years old. It's the first and the largest community development financial institution in the United States. Having said that, in all humility, after 35 years, we're just at $2.8 billion in assets, though about $3.5 billion in cumulative mission investments over those years. And we really do need to scale that if we're going to have a broader impact. It was very interesting that last week, the head of the Federal Reserve, Ben Bernanke, made the observation that as all of our larger financial institutions are imploding, it's the community banks that he thinks could really be the network for rebuilding because they're more connected to local economies. And Shorebank is one of those community banks, but the challenge for us is, because I do believe this is where some real value resides, how do we scale this and get ourselves to be a larger factor in the financial sector, in the mainstream finance, because that's where I think we would find some durable solutions. It was a Skoll Foundation executive who noted to me that on the very day that Lehman declared bankruptcy, they received notice. They're an investor in ShoreCap, a small investment fund that Shorebank started some 5 years ago to invest in financial institutions in the developing world that do small business lending and microfinance. And so they got a notice that day of an internal rate of return for ShoreCap, which is north of 24%. I like the juxtaposition. Though we're small, we have big aspirations. And earlier this month, Triodos Bank in the Netherlands, BRAC in Bangladesh, and Shorebank together announced the formation of a new global alliance for banking on values. It has 11 members so far, and the banks who are members have combined assets of $10 billion and serve some 7 million customers in 20 countries. The goal of the Banking Alliance on Values is to promote a back-to-basics approach as a positive alternative to the global financial system in crisis. We want to lead a debate on developing banking models we think could inspire profound change in the mainstream financial industry. So to try to move beyond a kind of parallelism that has occurred with the larger financial institutions dominating the scene and the community banks and others regarded as very interesting, but more of a sidebar than an integral part of the whole continuum of financial services. This is what I think the opportunity is in this crisis, because it is jolting us out of our belief in the, if I may put it this way, masters of the universe, who've been shown to not be all that we thought they were. I think that the blinders have come off, and in this context, we can really reinvent very, very substantially. Now, this is, though, it's a systemic crisis and not only a financial crisis. Alongside this, we have the issues of global warming, of pandemic health challenges with inadequate health systems to address those challenges. So this all is taken together. But I believe that there too, that the opportunity in this is that we have to recognize the complexity and interconnectedness and together devise a new international architecture for addressing these challenges. I was thinking when I was on the World Bank board at the time of the Asian financial crisis, when Indonesia was imploding, and it was the G8 who were trying to come up with strategies to address that, and Indonesia was not at the table. Next month, in April, the G20 will convene, and we're moving beyond a smaller set of countries attempting to devise strategies for the world into a more collaborative arrangement with more countries and players at the table, as there needs to be. We all have to have a stake in things, or we are unlikely to agree with the strategies that are introduced. Now, I don't begin to know, and maybe there will be some observations on this or as we open the dialogue, I don't begin to know exactly how we create that more inclusive architecture in a way that will work. But I do know that the conventions that have served us sometimes well and sometimes less well over the past decades are now, with this crisis, truly are not going to make it through it, and we are going to be doing some major reinventing. The one risk in this, though, is that it's what's been stimulating so far in the United States is I'm sure we're going to see a great deal more regulation, rigorous, uniform, and broader. And again, that regulation, too, is going to have to be transnational. And it would be unfortunate, I think, if it was only regulation that comes out of this. Instead, I think we need to do the kind of thinking that Ronald was alluding to is happening in the UK of what are the opportunities here. Some years ago, the Community Reinvestment Act drew banks to move and serve to some degree underserved areas. So I'm hoping, as we're thinking about addressing this crisis, we're going to think about what are the incentives now that we could introduce that could unleash the extraordinary capacity, both of government, of individual organizations, of the nonprofit, of all of the sectors. I mean, one thought, for example, is if what will emerge out of more regulation will be a kind of licensing. And if you were to set aside a small part of some of those licensing fees as a pool of money that could be available for the financing of ventures with positive public impact, such as the models that Ronald has been talking about, I think we would be opening up some tremendous possibilities. So I think, finally, my one other thought that I would throw out is that I think what has happened is going to create a kind of more of an impetus for the sort of blended values investing that has been talked about in this forum for some time, and also for rethinking what shareholder equity actually means, and moving away from a short-term quarterly earnings or financial returns into a broader understanding that takes account of externalities, of some of the negative impact of poor environmental stewardship and practices, that begins to reshape a longer-term vision of what constitutes value. Now, I'm very inspired when I come to the Skoll Forum. It gives me confidence that there are the models and the leadership that can take advantage of this opening and this discrediting of a former system to truly reinvent. As I think about the scaling that's going on, just one small example, I was talking with the founder of Room to Read yesterday and realized it's become a $28 million organization in just 10 years. And I think about the Acumen Fund and the tremendous number of funds and stimulus that it has had. And I think about the examples and the success, both financially and in terms of impact, that Shorebank has had with ShoreCap and several other funds. So I think we have the wherewithal, but we're going to have to think big, and we're going to have to challenge our previous assumptions.
Great. Sam Moss, could you maybe just start by explaining a bit about what you do, as people don't have your bios in front of you?
Sure. Gray Ghost Ventures and Gray Matters Capital, which is a subsidiary of that, is a $200 million social venture fund founded with one person's proceeds, Bob Patillo. That's good and bad. The idiosyncrasies of a high-energy entrepreneur kind of are visited to us every day, mostly in positive ways. But with that, we have about $170 million invested in the social venture activities and about $30 million in a variety of different trusts and foundations. In the $170 million, we have about $50 million committed to microfinance, 18 funds, many of which we helped create with others, half debt, half equity, about 50% exposure in Latin America. The second part of that, we have a social venture fund. We used actually the proceeds from the Gray Matters Capital Foundation. We can come back and visit that in a second. Which we do in direct investments in companies that are focused also in developing countries and underserved populations there. We have then recently in the last year started in Hyderabad affordable private school financing. As you may know, the difficulties of the government schools there have created an incredible opportunity for private education. In Hyderabad alone, a city of 5 to 6 million people, there are 3,000 to 4,000 private schools that are operating outside of the public school activity. As they grow, they need financing of $20,000 to $30,000. That's larger than microfinance institutions are generally willing to look at. So we've started a fund there to examine whether we could provide the financing, and if and as successful, we'll then open it up to others. Within the foundations, Gray Matters Capital, one of the things we found is that within U.S. laws, the $16 million that we have within that foundation, if we did private equity, we would be restricted to a very small fraction of that. We decided to take an aggressive approach of looking at it as mission-related investing, and we put $10 million of that $16 million into private equity activities around the same missions that we have of certain underserved populations. So we expect to be able to go and visit Bob in jail once this is published out here. But we've seen, in the terms of what this conversation is, in terms of the government activities, the laws there are archaic around foundations, and it's not that they intend to be. They look to the past, and so they're starting to look towards the future. And so there's much greater flexibility around foundations being able to use their financial assets in very positive ways and using it as investments rather than just as philanthropic capital as well, and starting to merge these two ideas of high impact social investment as well as expectation of financial return.
Great. So do you want to talk more broadly about how much opportunity there is more generally in this crisis?
Well, I think that what we've seen on the government sides, they've become quite active, especially in microfinance, in terms of first loss categories coming in as they're going in. So to encourage more investors to come into that. The important part of that will be when is the term at which government participation is no longer needed, and that's always been a little dodgy in terms of getting them out. Once the private investors are able to come in, there is that opportunity for exit. It hadn't been notoriously good at that. The other part is the currency risk. Most of the lending in microfinance, for example, is in dollars or euros. And so that hasn't been an issue over the last seven years or so in terms of the dollar base. That is currently a potential problem as they start trying to refinance. So government participation in those actually has been quite useful through the IFIs and the DIFIs and the rest of that, of trying to create areas to attract additional capital into it.
Great. Well, look, before we start to talk more about the opportunity, I think a lot of people here will be feeling, we need to make sure that we're still going to be around to actually take the opportunities that exist. And I wanted to tease out first with you, Sir Ron, what exactly is the economic situation from your perspective that we're facing? I mean, how bad is this going to get, and how much should people just be battening down the hatches at the moment and sort of just trying to fight through the next couple of years?
Well, I think it was clear that the higher we were going to go in the economic cycle, the lower we were going to come. And it would have been perhaps in retrospect a brave regulator who would have stood in front of the thundering herd and said, hey, you're taking too much risk. I mean, Greenspan did, of course, in 1998, I think, make his speech about irrational exuberance, and perhaps we could have done with another speech in 2003, 2004 about gargantuan appetite for risk. But it was quite obvious, I think, that there was a huge balloon of debt. And the financial system got a lot of air from increasing deposits in China and India. We blew the balloon up as much as we could. When Bernanke came in and interest rates came up, we had to let go of the balloon. And what does a balloon do, Matthew, when you let go of it? It just goes all over the place, and then it drops, and it takes a while to blow it up again. And I think that's the image that I have of it. The balloon is still going in unexpected places. We've not seen the last of the hits to the financial system that will come from write-downs on leveraged loans and property loans and consumer finance. So we're not at the stage where we can say the financial system is repaired. We can now begin to function with the, with a real economy, if you like, as we're used to doing. We're still very constrained by the lack of credit. Now, how long will it take for the financial system to be fixed? I don't know, maybe the end of this year, maybe first quarter of next year. And how quickly will credit flow? Well, given the hits that have taken place and the fact that the balloon was overblown, you can't expect to go back to the same amount of credit that you had before. So it's going to be gradual coming out of it. And at what stage does unemployment stop climbing? Well, it'll be when credit has flowed enough, when uncertainty has been dispelled, and when consumers are becoming comfortable in spending. So it's tough for me to see a scenario where next year is going to be great. I think next year is still going to be a year of repair. Perhaps in 2011, end of 2010, beginning of 2011, we can begin to see the trends reversing. But even when they reverse, I don't think you're immediately going to go into very high growth situations. We're likely to see a period of inflation following this. We're likely to see higher interest rates in order to control inflation. So we're not out of the woods. And I think it's important for us to be able to take this situation into account when we plan the development of our social organizations, not to go off on the basis of false premises. But I think what you've heard this morning is that it isn't a question of just cutting everything back, because the social need's going to be so great. And if we can make our voice heard with government and use intelligent approaches, I think the social sector can emerge from this, as Jan was suggesting, a lot more important than it was before we went into this crisis.
It's interesting because the phrase that you use to describe government sort of shocked me a bit, because I suppose I'm spending most of my time in America at the moment, and the idea of don't give up on government, is the last thought that's going across anyone's mind at the moment. I mean, there's this tremendous resurgence of faith in government, which I think by people who had given up on it. And the social sector leaders that I talk to, I feel are in a kind of paradoxical position that on the one hand they see the most sympathetic government towards their issues and approach that they've ever dealt with, and on the other hand they're aware that there's a lot of money being distributed now, much of it, they don't know whether they should be trying to get more of it or not, and a lot of it without their efforts is going to bypass them altogether and repeat many of the errors that in fact they came into business to correct in terms of bad government spending. So I'd be also interested in getting your sense of what you see, because why you seem to posit a much more constrained environment for government.
Well, I use that phrase because I think government will continue to be very supportive and pay lip service to the things that we do, naturally. But when you start asking for allocations of capital, you're going to hear, we don't have the budgets to provide it. And we're already hearing that here in the UK. And you could have a reaction to that of saying, look, government doesn't have the money, let's just cut back and shrink our activity, despite the fact that the need for the things that we're trying to do is greater than ever. And I'm saying that would be the wrong thing to do. we have to make our voice heard with government. We have to persuade government that even hundreds of millions of dollars going into social investment organizations is a lot less than the trillions that are going to go into the economy and the financial system. And that without it, social tensions within society will rise to completely unacceptable levels. The things that we are able to do today should persuade government to let go of the purse strings, but they won't necessarily.
And I think what's interesting about some of what you're doing, though, is it's not government money coming into the sector by way of straight disbursement. You're actually unleashing some resources that were not available before to either government or this sector. So maybe you should say a word about the banking assets, the tapping the banking assets. Because I think that's what we have to do. We have to think more creatively than simply government allocation, but how do we trigger with policy some new flows?
Well, let's come back to that actually in a moment, but I also want to push you a bit on an interesting conversation I had. I went to a meeting called The Gathering, which was a lot of leaders of non-profits that were working with New Profit Inc., and they're very well connected to the Obama administration. And the debate that was going on amongst them was, you know, how hard should we fight to get the money that's available now? That in the next year, governments are going to be throwing cash out like there's no tomorrow. And the issue was, well, do we fight hard and get the money and scale up in a way that we hadn't planned to do and which we can't count on being able to sustain beyond this stimulus package? Or do we just sort of continue to think incrementally and it sort of struck me that the only people in Washington at the moment, and presumably in London, thinking that way are the social entrepreneurs. Everyone else is just trying to grab as much money as they possibly can. Now, what's your advice to people in this situation? Should you just be, you know, doing what you can to get as much money in through the door now while the good times, government-wise, are still happening, and then deal with the consequences tomorrow? Or do you just continue to think long-term and strategically? I mean, Jan, what do you think?
I'm just a little surprised because I don't think that, I think it's sort of the wrong question in a way for organizations to be saying, you know, how do we get some of the money? I was recently at a meeting talking about the social investment fund that a candidate Obama, now President Obama, had proposed, and talking about how that might work out. The president has created a new office in the White House on social innovation, which hasn't existed before. A point was made at that meeting, as people were talking about the social innovation fund and how it might operate, that the amount that was unleashed by the Community Reinvestment Act would dwarf the millions, would totally dwarf the size of the social investment fund, and suggested to those assembled that we better think more creatively, that it's not about the direct government allocation may not be what we should be after at all. And I think Sam was pointing out sometimes when government gets in, the exit is less graceful. So that's why I would say that's sort of the wrong question. We've got to look at for all organizations, what they do and how they scale should be driven by their constituency, their need that they are addressing, and their capacity to expand.
Sam, do you want to?
No, I'd actually agree. I think that any kind of funding that comes from a government source would have to be, it's healthiest to believe that it's temporary, and as long as it then accomplishes the goals of the organization, and the organization then can make a determination of how to get along without that, it's probably a healthier strategy.
Okay, well, let me challenge you on that then, because it seems to me that, you know, we're talking about a group of people who I think have thought harder about social innovation and how to solve society's problems than anyone else over the last 10 years, 20 years or so in this sector, probably in this room. And over the next 2 to 5 years, maybe the next 1 year, the whole course for government's relationship with the economy globally and nationally will be set. And vast sums of money are going to be allocated in ways that will not easily be shifted from where they're allocated over the next year or two. And tax breaks will be given or taken away, as may happen with the charitable sector in America. And, you know, I would want, in an ideal world, I would want this room to be deciding how that money was spent over the next few years. This is what I would love to see happen. And yet you talk about, I think the sort of thinking that I'm hearing is continuous thinking. It's the thinking that says room to read has got to $28 million, that's great, which it is in the old paradigm. In the new paradigm, I want to see how room to read is going to get to $2.8 billion or $28 billion, because that's the sort of money that is going to be shifting around over the next year or two. And I want to know, how does this group actually take scale seriously, in this new world that we're building? Are we just going to leave it to all these people who for the last 20 years have been filling their pockets at Goldman Sachs and now decide that the government's the career for them and they're going to do it exactly the same old way? Or are you actually going to find a way to make this crisis a genuine opportunity? Ronnie?
Well, Matthew, you followed the private equity industry for years. We've been in the trenches together persuading people that, private equity could help entrepreneurship and so on. It didn't happen because governments did things directly. It didn't happen because governments funded private equity funds wholly, although they provided useful matching finance in different cases. And I think what we're saying today is if we want to create scalable, sustainable organizations, we're not going to do that on the back of government money only. Now, you didn't get my reaction to if offered money, do you take it? The answer is yes. You take whatever you can when it's offered to you, because it may not be offered in the future, and you marshal it in an intelligent way. But if you want to try and create scalable organizations that, that have revenues in inverted commas and social benefits created of billions of dollars each, you've got to be able to connect the social sector to the capital markets with the help of government incentives. You've got to have an organization like social finance or the social investment bank that can issue $100 million or pounds of bonds for a specific purpose, where tax incentives are given to those who are purchasing the bonds, who could be individuals from the public or institutions of one kind or another, and that money then gets redirected to the sector. You've got to enable some of these large organizations to raise equity. The concept of equity for a not-for-profit organization has been defined now. It is possible to raise equity. You can define a security where the organization or the person providing the capital starts off with a low level of return of 3 or 4%, and then depending on the surplus that is creating in the organization, I'm thinking of organizations like the Charity Bank or perhaps Shorebank, the surplus that is created, you give an entitlement to a share of that surplus and you cap the rate of return at 2 or 3 times the original return. The value of that security will have trebled over time. And providing the record of the social investment organization is solid, you'll be able to sell it into the financial system. I think the break in thinking isn't so much in terms of scale. It is in terms of scale. I mean, you're right. There is a major leap in terms of scale. And we've got to move away from the voluntary, self-sacrificing, amateurish approach to solving certain issues, to saying that's fine at a local level for certain types of organizations. It's precious and it's important. We don't want to destroy it. But we need to create scalable, sustainable organizations that can have major social impact. And if you're going to do that, then the paradigm is a lot broader. It's about how you finance yourself continuously without dependence on the government.
Sam?
No, I would agree. I think that that's exactly the point, is that if you can see how the value, the available money helps you accomplish that greater scale to serve a greater number of people in an effective and a sustainable way, that's absolutely what you should do. There's the problem, are you prepared to do that? Can you be prepared to do that? And who is able to do it? And I think that those are embedded in those issues as well. But scale is absolutely the critical one. And then how do you wean yourself from the dependence on a government who is not always as thoughtful about what it is that you're trying to do as you may be?
Okay, I'm going to throw it open to questions in a moment, but I just want to continue to challenge you on this, because I suppose, we interviewed Alan Greenspan the other week at The Economist. He said $50 trillion has been wiped off the value of global equities since September the 15th last year. $50 trillion. And, that's just a phenomenal number. I mean, and it just makes some of the numbers we're talking about here seem, I don't know, kind of completely trivial. So it seems to me the scale question is extremely important. The second issue is, I mean, you know, you're talking about the return of private capital markets, but to my mind, the capital markets are now being owned by the governments of the world, particularly the American government. And although, you know, in an ideal world, perhaps they figure out how to make them work again and sell them back to the private sector. But the reality is actually, you know, it sounds like the plans are going to be to involve all the private equity firms in partnerships with the government to try and sort out the bad debt problems that are already out there in the system. So it could be, you know, this is actually increasingly going to be in the hands of government, whether we like it or not. And so this sector has to influence government policy if it really wants to have access to any serious amounts of capital. Now, maybe it can bypass the capital markets and find ways of doing it without spending a lot of money, but, and you know, I guess no one's had more experience of doing that than this group, but you know, it seems to me that that would be a tremendous waste of the opportunity that's there. So how do you start to really change government policy in a way that embraces all the learning that this group has, rather than sort of wait for whoever hasn't got the learning to waste the money over the next few years and then come to you again when we need another new paradigm?
Do you want to answer that, Jan, or do you want me to?
The one observation I would make is that government is made up of individuals, and it's part of who is in government, and I'm seeing a lot of individuals with this kind of set of values going into government, at least speaking for my own, but I also see it as I look around the world globally. And I look at the inclusion, if I might say so, of more women in government, which I'm not positing that women are, but there's hitherto untapped resources are going into government. So I just make that observation.
Do you want to go next?
No, please.
I was going to say, I think the paradigm is going to change in different ways. The world financial system is not going to look the same. Banks have got too big to save in certain places. You're already beginning to see the bond markets opening up for corporates. You may well find that actually the corporate bond market becomes a much more important source of finance than it was previously. In the context of that, even if there's 10% unemployment or higher levels of unemployment than that, the 80%, 90% who are unemployed, many of them will feel that, look, we've got to do something here in the face of these problems. Those who are better off, some of them, will feel they want to do something to help. And so I think the first part of the question is, if you are imaginative, you can find ways of accessing capital markets directly, even at times which are going to make it a lot more difficult to do that. On the question of relationship with government, for many, many years, I was involved with the government on private equity. I've been involved in trying to help the social investment field. It's not that government is not willing to help. It's not that they've not created ministries to focus on it. It is that they are still thinking, to use your words, of the old paradigm. The voluntary sector is still considered as an ancillary. It is not viewed in the way in which, say, the private equity industry is today. It is viewed as the private equity industry was in the UK in 1980. You know, it sounds interesting, but is it really going to get there? Can you really use financial instruments for social benefit? Is it really genuine that people want to help others? Or are they doing it for some ulterior motive? This is what we're up against. And we're up against it not at the highest levels of government necessarily, but very often at the level of the civil service, where the departments have competing interests. For instance, social finance, the Social Investment Bank. I'll answer your question, Jan, because I think it's interesting. Social finance arises from the fact that in Britain, unlike the United States, Canada, South Africa, Ireland, etc., if a deposit in a bank is unclaimed, don't know where the person who has the deposit, person has disappeared, died, moved, forgotten about it, can't contact the person after repeated attempts. That money in Britain, unlike these other countries, stays with the banks. Now, Gordon Brown started it as Chancellor and then has insisted on it as Prime Minister, has said, look, this isn't the bank's money. This money's got to be used for social good. Okay? And then speeches were made in Parliament saying, we're going to spend it on youth facilities across the country. Okay. Then the voluntary sector comes to me and says, let's create a commission to look at what we should do with this money. Maybe youth facilities is not the best use of it. We come out with a concept of a social investment bank, and we say to the government, you know, there might be £400 million to £2 billion flowing from this over a period of time. Give us 300 million of it. With that 300 million, we will issue bonds worth 700 million in our view, and we will revolutionize the flow of capital to the voluntary sector. We call it the voluntary sector in Britain, or social investment sector. You can't manage to get a clear decision quickly. The bill's made it through Parliament. It still talks in terms of number 1, youth, number 2, financial exclusion, number 3, a financial wholesaler. And so if the question is, how do you manage to get decisions on these types of things? As a sector, just as the private equity industry did in the 1980s, we've got to raise our profile. We've got to lobby, we've got to appear in the press, we've got to make the case, we've got to commission research which gets published. We've got to raise our profile. Otherwise, we're going to be lost in the noise.
I guess I find myself thinking, why don't we just forget that and try and get the guys who run Charity Bank and the women to run Charity Bank in charge of Lloyd's and see how they do that with that? Because, I mean, the government has to appoint a new board to some of these companies, and perhaps people who come out of this sector might be the people to run that, and would do it a lot better than the previous lot, but that's an aside. I want to ask you, if you're going to the bond market, what do you have to do as a social enterprise that's different? Do you have to get your, I mean, are people's business models clear enough now to articulate, to raise the finance in that way? Ronnie?
Well, that's why I think a social investment bank is a very important step in doing that. Because if a social investment bank issues £100 million worth of bonds to deal with reoffending and takes 10 million of it on its books and places the other 90 million through the market, it's very different, and then lends it on to, or finances in one way or another, organizations in Britain or elsewhere, I mean, in this particular case, we're thinking Britain, to help people not to reoffend by training them, by finding them jobs, by giving them the psychological support that they need, and in all the other ways. It's much easier than for any one reoffending organization to try and tap the capital markets. That's why, you know, we call it a financial wholesaler for short. It's really an intermediary between the organizations that many of you in this room are leading and the financial markets. Today, we can't tap the financial markets. We can't get government grants easily. We can't borrow from banks, and Charity Bank only has £34 million worth of deposits compared to Lloyd's and so on. And the donations that we receive from foundations are going to shrink.
Okay, one last thing. I keep getting more questions. I'm intending to go out to the audience, but I mean,
I think we should.
I should. I just want to ask this one last question. There's this huge problem for years. Everyone has been trying to raise capital from the mainstream capital markets, particularly from pension funds and so forth, and they come back with, they're told that they can't have this because of the prudent man rule or the trustee rule that says you have to do what conventional wisdom says is the correct way to manage money prudently. Now, my view is the prudent man rule has been rendered completely obsolete by the utter failure of the capital markets over the last 2 years. Now, does this create a fantastic opportunity to unleash those billions and billions of dollars that remain in the pension funds to actually be invested in a way that is genuinely prudent by addressing long-term sustainability and things of that sort? Jan, why don't you take the first shot at that?
Well, I think that's really what I was saying, that there was, that we, for so long, shareholder value in the United States has been defined in terms of financial return and really quarterly earnings. However, as we're now beginning, more than beginning, we're well into it, we can quantify the negative impacts of poor environmental practices. And as those begin to be incorporated into the metrics, and there's a lot of moves toward this, then I think we will see a different kind of valuation. And in fact, we are seeing pension funds beginning to move in this direction. In the last Shorebank capital raise, for example, the Illinois Student Loan Association, which is a kind of pension fund, they had just passed a policy to aggressively seek, with a certain percent, a small percent, very small percent of their assets, but to aggressively seek investments that also had a positive positive social impact along with financial return. And it was under that policy that they were able to invest in Shorebank, even though at the moment it's a privately held company and it's illiquid, but they could do that. That's tiny, but we're beginning to see the fissures that we can walk through to broaden this.
But do you feel that they accept that the credibility of that old legal discourse is now gone, or is this sort of going to be 2 or 3%?
No. I think this is more of a, it's evolving, but it's not like it's disappeared by any means. No. If anything, in some ways, it goes the other direction because the losses make all investors very wary.
So we've just come back from kind of having a series of conversations with pension funds in Netherlands, which is actually quite open to the idea. But I think that what we've seen is that there is a Dutch bank whose best performing portfolio over the course of the last year has been their microfinance portfolio. It was positive, where everything else was negative. That actually starts causing pension funds, which tend to be risk thoughtful going forward, that this whole issue, to the point you've made, it's reverse it. I mean, a perfectly allocated portfolio over the course of the last year has declined 40% in the United States, except if you had a microfinance piece within that. So this whole issue of the belief that because you are actually doing something that has high social impact almost requires high risk is absolutely being rethought. And the thought that you have a financial return that's that is a market rate financial return as well as a high social impact is not an alien thought anymore. And the more progressive of those pension funds are actually believing that. So I think that we're in the process of really having a substantial shift in the thoughts of that. And I think even the VC funds, the Kauffman Foundation actually is bringing in social investment managers, and actually in addition to the purely financial managers, and they're cross-fertilizing each other in terms of the thought of just because it has social impact doesn't mean that it doesn't have satisfactory financial return. That will substantively change now. That will take time.
Ron.
Well, I'll just give you a specific example, Matthew, which is Bridges Ventures, which is in the market at the moment to raise £100 million for property investment in poor areas. Bridges started off, as some of you will know, in 2002, raising the £20 million from the private sector with matching finance from the government that I referred to. And the investors from the private sector were local authority pension funds, banks, private individuals, venture capitalists, entrepreneurs, and so on. And the goal of Bridges is to invest only in the poorest 25% of Britain and to show that you can achieve satisfactory returns, which we defined as half private equity returns then, so which we said is 10 to 12% net of fees. In every other way, Bridges operates like a normal private equity investor. The management team has management fees, it has carry, it's got an incentive to build the business and so on. The results of the first fund were great. We created a very powerful role model in Karen Darby, who was a single mother of 3, left school at the age of 16 with 3 GCSEs, and with her business partner turned a call center company from £300,000 to £22 million worth of value. So just outstanding. On the back of the results of the first fund, which it's not just a call center, it's a call center with a cost comparison engine for utility bills. We can go into that in questions and answers if you're interested. On the back of that, we raised £75 million. It was very tough to raise any of the money from pension funds. Very tough. We raised some money from the University Superannuation Fund, which is great, but pension fund trustees on the whole are very conservative in Britain. And now as we go out to raise £100 million to invest at the bottom of the property cycle in the poorest areas where property is worth less than anywhere else and where you'd think people would be rushing in, saying instead of 12%, these people, while doing social good, are likely to deliver more than 20%. It's proving extremely tough to get trustees at a time when their portfolios are shrinking to take risk. They find themselves with illiquid portfolios hit by a decline in markets of 50% in public equity markets and declines in private equity and other classes. It's very tough. I think it's tough to rely on it. And I mean, the only thing I would ask, Sam, is that you see if you can help us with some of the Dutch pension funds, which may be more adventurous.
But I mean, it's crazy, isn't it? I mean, really. I mean, they can't see the opportunity here. But anyway, let's throw it open to questions, comments. Yeah, there's a lady in the middle there with her hand. You say who you are if, before you ask the question. The mic's just coming to you here.
My name is Kelly Clark. I agree in terms of the triple play being possible and that the commercial markets beginning to see that. But I think the thing that's not often expressed, and I'd love to hear the panel's point of view on this, is in order to make those social enterprise investments yield double-digit returns, there's often subsidization in the deals along the way. And the ways in which those deals are stacked often make it possible to achieve the double-digit returns or even the high single-digit returns. And that seems to me to be an opportunity for the government to realign some of the capital it's able to deploy, as well as the pension funds. So I just wanted to hear a little bit more about kind of the bridge between that, where we are now in terms of the perception that social enterprise doesn't yield returns and the reality that it can, but some of the subsidies along the way to make it happen.
Jan, do you want to take that?
I'm really glad you brought that out because I think it is, and the bridge is a good term, and there's, I think now, good innovation going on in thinking about how you can structure investment opportunities so that you can lever in the private sector, as it were. For example, Shorebank recently had the privilege of being engaged by BRAC in Bangladesh to create a loan fund to finance their expansion of microfinance activities in Africa. And we did it with Laurie Spangler, who's the president of Shorebank International and quite a creative financial thinker, designed a two-part two-tiered structure so that we could go out to more philanthropically minded investors to purchase with a slightly higher risk profile, and that would leverage in the more market return investor. What was interesting to us, though, was that when we went to an organization like the International Finance Corporation, you're referring to the IFIs, which is in business for development, they wanted nothing to do with the B coupon. They only wanted the market rate return. So we said, thank you, we're not going to go to the IFC on this one. On the other hand, OPIC, the Overseas Private Investment Corporation, a government entity, which had never before invested at a lower than maximum financial return tier, we said, we will only do this if you will buy both coupons. And they did. And that created a new precedent. I think that what we desperately need is what we've called at Shorebank for years patient capital. And there is an implicit subsidy, of course, because our investors, while investing for profitability and development impact and conservation, while there is a modest dividend, certainly it is not the same return, the same financial return they would experience in other investments. So there has to be thinking about ways that we can package.
Well, I'm not actually entirely sure that you need that capital on the front end coming in the form of grants. In some cases, it may be beneficial. But in the things that we've seen, there are opportunities, especially on the equity side, that wouldn't require any kind of capital coming in from the grant capital coming in. Now, there are stages where, again, if it's a pilot phase, trying to attract people in to demonstrate its success, I think that there can be that opportunity. It's the exit, it's removing it as quickly as possible so that other capital sources can come in.
Well, I'd love to answer the question by looking at a specific example in the Middle East. My time is divided now, 2/3 of it, half poverty in Britain, half using economics in the Middle East to encourage peace. And as part of that work, which is carried out by the Portland Trust, we've been working on $1 billion affordable housing scheme in the West Bank, and we should be breaking ground in June, politics on the Palestinian side, in this case, allowing. Now, if you look at the risk-return profile, the numbers only work if you have a 15% leveraging grant. You can raise 85% of the money from the private sector, and the entrepreneur who's leading the first half of the program, $500 million, has already got his equity in place, and mortgages are in place to provide some of the debt funding through deposits and eventually the purchase of the homes. But actually, given the very high risk profile, the numbers only really begin to work if the infrastructure spend, the roads, the sewage, the electricity, the water, which comes to about 15%, the public buildings, the school, the hospitals, the soccer pitch, and so on, is paid for from outside. You have no chance of raising this money if you don't have that money up front. Or, you know, you need a miracle. You need a government to make a disguised grant. So we've gone to various governments and said, will you provide this leveraging grant? Now, what you discover there is a major issue. You discover that governments like to lend to other governments. The last thing they want to do is to invest in a project where a Palestinian entrepreneur or any other entrepreneur is going to get rich as a result, which is the purpose of it. And so we're trying now to institutionalize for this particular purpose, and maybe it'll last a few years. There'll be, instead of 15,000 homes, maybe 30,000 homes built if you provide the incentive or more. And the impact, by the way, is huge. The billion-dollar investment increases GNP by 1.5% a year for each of 5 years. So for $150 million of grant, you can get a 1.5% increase in GNP. It touches the lives of 200,000 people. And so the reason I'm mentioning this is somehow you've got to get structure, because structure really determines the strategy that you can follow. And the structure that's required now is for the European Union or the World Bank or some other organization to create leveraging grant facilities where 15% of the money comes in the way that I've been describing, and the rest is raised from the capital markets. At the moment, what we're doing, and I'm off to Canada in a week's time to talk to the Canadian government, we're talking government by government, cap in hand, saying, look, this is a worthwhile project. It will achieve things that the billions of dollars that you're giving in budget deficit finance will not achieve. It will achieve the strengthening of the private sector, which is the primary source of employment and of a sustainable economy. And it's virtually impossible to do unless you can create the mechanisms. So I think for pilots, as Sam was saying, of this kind for a period of time, I think it's absolutely necessary, and we need to get structures in place if people are going to be able to take advantage of them. For bridges, I think bridges can deliver returns that are half or more and perhaps higher than those of the private equity industry without any government help now. The last thing bridges wants is additional government help. It doesn't need it. It wants to be sustainable in its own way. These are areas which are completely starved of capital, where the valuations at which you're investing are low, where most other sources of finance have no faith at all in the level of skill or motivation of some of the individuals involved. And it's unconnected to the public markets, interestingly enough. These economies thrive better in difficult times, or at least the concepts that you back thrive better because they're much more cost competitive.
So let's take 2 or 3 comments, questions in one go. There's a gentleman at the back there, yeah, and then we're going to come down the front to the lady in the pink top.
Thank you. Well, Marcello Palazzi, Progress Foundation in the Netherlands. I totally support Matthew's point, and I think that if you look at the microcredit summit campaign, 1997, what they were able to do by organizing themselves properly. And I think that I was at this meeting you mentioned, Ian, about this Global Alliance on Values in the Netherlands, and they want to go to 75 banks. So I think it's a time to create coalitions among new players, and if Skoll and Schwab and others who are active in this field could get together and do the sort of things that Matthew suggested, I think it will be really scaling up the game. The second thing is that if we don't do it, the money the governments are making available is going to be spent in the same way it was spent in the last 20 years, which is, of course, the whole model of social enterprise wants to be different than a traditional bureaucratic, bottom-down model. So there's a double incentive for doing this sort of thing. So I think, thank you.
Okay, and then down here.
Yes, my question is with respect to how do we encourage pension funds to increase their allocation to this asset class. Ronnie Cohen, you touched on this in terms of the correlation. Can we make a persuasive case that this asset class actually has a low or negative correlation, and not necessarily in a geographic sense? Clearly, we need to break this down, whether it's in Africa or whether it's in the UK and so forth. But I think empirically we should be able to demonstrate that if there is anything that is negatively or that has a negative correlation or a low correlation, maybe this is the asset class.
Could you just say who you are for the recording?
Yes, I'm sorry. I'm Herta van Stiegel from Aria Capital.
Great. Let's just take a couple more as well. Yeah, behind, up there.
Hi, Ben Gill from Bioregional. It's just a quick question really about the Green New Deal, which I'm surprised hasn't been mentioned. It's the second session I've been to, and we've not really talked about the link between the social and environmental issues. And it seems that with this crisis, or the financial crisis, we need to resolve two issues to deal with climate change. One is we need this large amount of public money going into energy efficiency and sustainable transport schemes, but we also need to be restructuring the financial market so when we come out the other end, we're not going back into a system that just promotes increasing carbon emissions. So any thoughts on how we're going to do that would be great.
Okay, and then one more over there, gentlemen.
Yeah, Kees van Gessel, I'm representing Blue Orchard from the Netherlands, but also in Geneva, of course. Two remarks. I think recently there has been an initiative which gives a lot of support to the microfinance market, which has been constituted by the IFC, KfW and FMO. What they have done, they have founded an institution or a corporation, $500 million, which is founded or put together in a microfinance enhanced facility. We are, as Blue Orchard, playing a very important role in that. The remarkable thing is that at the time that we announced, or that it was announced, it has given a very, very, very sound, solid, let's say, news to the market, in particular to the Dutch institutions, because they thought that if this is going to happen, then, you know, it is a sound market. Up to now, we were not, or nobody has not yet used even the market. It was an enhanced facility because the microfinance market has no problems in bad and defaults. The only problem is that we are faced with an all of a sudden standstill of institutions coming to the market and giving new loans. So this is an enhancement which can be followed by some other initiatives, particularly. Secondly, information is crucial. Where the Dutch institutional investors are looking for is a sound risk. And I've been around there, and I always told my friends over there, you get the sound risk, you get a low return. But if you combine the two, you get a return which is on average, maybe to your liking. Well, they have said you have done a very good job over the last year because we were the only ones who came up with a very sound solution. So they're still giving it. And that source is indeed coming up, and we have tapped millions of dollars there, and it will continue. But it depends on the information flow, which is so important to that. And we are not very pleased sometimes as big institutions and also publications are coming up to a stream, as the Economist did on Friday, the 13th of March, indicating that the microfinance could be the newest source of, let's say, comparable with what happened in the United States with the bonds over there. And hopefully that this type of publications could be corrected.
Great. Well, I'm going to come to the panel. You don't have to answer all the questions, but between you, can you try and touch on all of them? Jan first.
Okay. The environment. Okay. And I would say too, I think the question about how do we increase the activity of pension funds in this area, it's the track records. And you've heard allusion to track records, and we didn't have those 6 years ago. So that's what gives me heart, is that we're now building those track records. SureCap International, when it started, was the first fund of its particular kind, and It's outperformed to date. It hasn't made all its exits yet, but it's outperformed its financial projections with substantial social impact. I want to come to the environmental. I'm so glad this environmental point was raised, and it's part of what when I was talking about a shift in shareholder value. I think a lot of, in this opportunity, a lot of the advocacy and the focus, I think a lot of good work has been done now to show and to quantify the costs of not having taken into account environmental impact. And so I think we're on the right road, but I think those in the sphere have got to work harder. And I'll say it is, there's still something of a bifurcation. Shorebank started out as a double bottom line institution looking at financial profitability and sustainability and development impact. And it was when EcoTrust of Canada came to Shorebank and said, we think we need a financial institution for part of what we're doing. Could you, out in Portland, we became involved in a bank there. And so then Shorebank realized, well, conservation ought to also be integrated into our core mission, so we adopted conservation as well. And it wasn't easy as we began to work, particularly with inner city borrowers in poor neighborhoods, for example, in Chicago, where they thought that paying attention to energy efficiency was really a luxury of people who were more affluent. But we began to develop products that looked at the cost savings and to front-end energy efficient appliances and thinking about ways that we could demonstrate the link up. And I think that's really where we have to be now, is not thinking about social impact on the one hand, environmental impact on the other, but truly integrating it and interweaving these as we think about value across the spectrum.
Sam?
Well, I would tend to agree with a lot of that. I think that the issue of correlation is actually very important. There hadn't been a lot of data in microfinance alone, which is the narrowest and probably best defined of the social investment areas, just now is starting to move away from anecdote to data. And I think this year, or these years, are going to be critical of trying to aggregate that. There's an International Association of Microfinance Investors whose entire purpose is actually to correlate data to demonstrate what is that correlation place. And so that's the value of some of these institutions now. And I think it's very important for the funds as they go out and talk to the pension funds who continue to have capital to invest, to demonstrate here is what's happened over the last 5 years, here's what's going on over the last 2 years. The misfortune of it is the 90 microfinance investment funds have really only been around for a number of years that doesn't give you enough data to actually feel comfortable with. It really requires somebody to believe it and then leap forward. Some pension funds and some investors are prepared to do that and others are not. It's going to take time for that.
I think if you look at what happened with the private equity industry, it's quite instructive, because I think there are big parallels between social entrepreneurship and business entrepreneurship and the systems that are required in order to support both. We would not have got anywhere without the prudent man rule and ERISA legislation 1978-79 is the truth, because pension fund trustees in the United States were very conservative and really didn't want to look at this asset class. And the prudent man rule, basically, for those of you who are not familiar with it, said any sensible, experienced investment manager should consider private equity, or venture capital as it then was, as an investment, and explain why they decided not to invest in it if they decided not to. Now that transformed the role of corporate pension funds in supporting venture capital funds and private equity funds subsequently. If we want to bring institutional investors in, we need to have a social need rule. But that could be quite difficult to define, because you would have to come up with the sorts of examples that we did in those days, and government would have to encourage trustees to accept responsibility to do something on the back of social need, even though it requires an act of faith. You know, explain why you don't want to do it. It puts the onus on trustees to do it. Without that, I think it's going to be very tough in most countries, perhaps not in all countries, but in most countries, to get trustees who are still extremely conservative to invest in a new asset class of social investment. I'd like to make a second point. We're getting the least help today from foundations in the UK. £60 billion is in the coffers of foundations. who defined their role as straight philanthropy. Well, we need capitalism to come to the trustees of foundations and for them to accept that a straight donation, which does not have the sort of leverage associated with it that social investment does. If you like to take the old, the old example of the fish, giving a hungry person a fish to eat versus teaching to fish, social investment is trying to teach people to fish. It's trying to do things that have a significant multiplier associated with them. But the way in which foundations, trustees of foundations approach this is that doesn't really fit within the ambit of what they're doing. You know, it's neither investment, where you're trying to maximize the return, nor is it straight grant giving. And despite what's been written about program-related investment by the Charities Commission, it's still not entirely accepted. So I think we should not ignore the very important power of foundations and changing the attitudes of trustees of foundations at the same time as trustees of pension funds.
So there needs to be a real public campaign around that, do you think? Yep. Okay, let's take another round of questions. Yeah, we have a gentleman in the middle there, and then a lady a few rows behind, and then we'll go over to those two over there. So down here in the middle. Yep.
Nino Tillman from the Institute of Cultural Affairs. One of the things in the U.S., we're based out of the U.S., one of the things that we've noticed is that there's a lot of money at the top going towards banks and Fortune 500 companies with this, well, at least with this notion that if it's not stated clearly, it at least is implied that this is going to create jobs. And we know from our research that 80% of new jobs are created in small businesses of 10 employees or less. And this also includes nonprofits. And so the question is, in this discussion, it seems that we're kind of focused on this large macro discussion, and when really, I think the innovation is going to come from those small entrepreneurs, and they've been historically locked out of opportunity in terms of getting any kind of funding. If you don't reach a certain threshold, you can't go to a bank and get finance. They're going to be looking at some very traditional numbers, and I think this is an opportunity for us. At least my organization believes this is an opportunity for the U.S. to lead the way in providing innovation that comes from the community level up as opposed to what has not worked in terms of innovation coming from corporations. What is the panel's thought on that?
Great, and then there's a lady just a few rows behind.
Hi, I'm Joanne Sawicki, and I'm a media entrepreneur. This is particularly to Sir Ronald. You mentioned several times about the industry trying to fix the system. I would maybe see that there's an opportunity right now, instead of trying to fix a system that maybe be outdated to our needs. What are your ideas on what would be the perfect new system, and could social enterprise not be working hand in hand with government to create pilot projects for them so that they don't fail openly? They can try and work in partnership, and maybe the opportunity is to sell into government these opportunities for a win-win.
Great, and then we've got the two gentlemen over there.
Olivier Deguet from FitTrust in France. If I can come back on the issue of regulation, which is very important. We have a very interesting experience in France. The French government has decided that by the end of 2009, all corporates which have a pension plan must include in the pension plan a social investment fund. The social investment fund means that they have to invest at least 35% of their assets in social programs or social projects. And we see companies like Danone, which has presently developed two tools. First, they are developing a for-profit social project, which is called Danone Communities. And second, they have just launched an endowment fund, $100 million, which is going to finance the ecosystem of Danone, which is all the NGOs that are working around Danone, aside Danone, because they want to help them with the crisis. So I think that the regulators have the power to influence and to force corporate institutions to move on those subjects.
And then to your left.
Nigel Kershaw, Chairman of the Big Issue and Big Issue Invest, with a fund which has started from a social enterprise that's created an embryonic social investment bank as well. Sorry, let me quote the great American quote. A long habit of not thinking a thing is wrong gives it the superficial appearance of being right. Tom Paine, 1776, Common Sense. It's about questioning everything. So I think there is a danger that within this time, all we're doing is mending and repairing a system and not creating the innovation. I think there is a danger engaging in government that we're transferring government monopoly of funds and a government monopoly of thinking into the private sector. I think what we're trying to do is actually create a new space where we're saying traditional philanthropy over hundreds of years, even with its reinvention in venture philanthropy, has not dismantled poverty. I think we're in danger of imitating a market. They used to tell us in social enterprise, you're addressing market failure. Well, where is the market failure? Because it wasn't with us. And there's a real danger that we imitate the market failure. So I think what we have to do in our challenges is creating something where it's not a yin or a yang, it's not a balance, it's not a blend, it's not an emulsion, it is actually something that is new. And that newness will be taken up by both the investors, and most important, coming back to that point, it's the entrepreneurs that we need to engage in that affect the thinking. And it's no reflection on you, or the panel before, I said this before, but in the financial workshops, the two of them, not one entrepreneur, social entrepreneur, there's been financial entrepreneurs, not one social entrepreneur sat on the platform. There is a danger that people are looking down and saying, this is what we think it should be, and not asking us what we think it ought to be.
Yeah, I think I think we have several social entrepreneurs here, but let's actually go to the final. Unfortunately, time is up really, so we're going to have those questions and comments will be responded to, and any final point that each panelist would like to make should also be included in their wrap-up. We're going to go in reverse order, so we're going to start with you, Sam, then Jan, then Ronnie.
Well, I think that the issue of community activity is actually quite important with that. I'm from Atlanta, Georgia, and the Community Foundation there has actually increasingly looked to create funds availability for not only arts institutions, but local institutions and small institutions in a lending fund there. And I actually think solutions are best when they're local. And to the point earlier that it's the social entrepreneurs, it is small, and if you can start small, it has a better chance of finding greater success that can be grown from that. A big tendency of taking these broad macro issues and trying to apply them down is that they frequently don't fit particularly well. If you can find the solutions locally and bring them up, we're much more comfortable with that, and that's actually kind of the genesis of microfinance as well. So hopefully kind of answering two of those pieces, we think including the social entrepreneurs in that process, because those where the best ideas will be generated, is on the ground with it. With that, I think we're encouraged about the activities that are taking place in the market. We come from the private involved space, but we actually have public-private partnerships with a number of the government institutions. Again, what we view is if we can find those things that can happen where they can encourage participation through government activity for a defined period of time and then exit, we think that that's actually healthier longer term, and you build better sustainable entities with it.
Jan.
Well, I just want to start my last intervention by saying I want to applaud the audience, because these have been such very good points that have been drawn out from the dialogue across the panel. And I'm particularly pleased to have had attention drawn to the move in France, because I think that really, as Sir Ronald was saying, we do need to create this kind of change, and we need to be looking at what's happening beyond individual country borders. We didn't talk a lot in this panel about exactly how we are going to achieve, how we're going to take advantage of the change in the international architecture. But I would think some of these ideas, if they can come up at the level of a G20, using the positive example of what France has done, where certain countries have led the way, we have to be thinking at that level, as well as, I would totally agree with all the points made about thinking locally and then scaling from there.
Well, local is crucial. And the reason for a financial wholesaler is a lot of small local organizations find it very difficult to subsist on a hand-to-mouth basis. In the UK, there are 169,000 charitable organizations registered with the Charity Commission. We reckon 3/4 of them have financial reserves of less than 3 months. So that's the, and you know, you're nodding your head, so you know what it's like. So local is crucial. With regard to the other two questions, which both have to do with the role of government, I think government has to play an enabling role. We're not asking government to do it for us. It's the fact that government is unable to solve many of these social problems that puts us in a position to try and use different approaches. And I think one has got to focus on some major initiatives of the kind that you've just described. If one could manage to use that precedent in order to create a social investment class just because there's an edict that pension funds and foundations have got to invest in this, that would be a fantastic way to do it. It's not that we're not working in a spirit of cooperation with government. We are. It's that the timeframes that governments are using still for our sector are the old timeframes. In the financial area, in the economic area, they're on the warpath. They should be on the warpath where social investment is concerned.
Okay, and I'd like to just add a final word myself. I mean, I've been thinking a lot about, you know, capitalism and its relationship to philanthrocapitalism, and how capitalism has been able to succeed so often has been to understand that crises are tremendous opportunities. And many of the great companies of the past, you know, century were formed, you know, at the bottom of crises by people understanding that the world had changed and that they had skills that they could use in a new way. I think the challenge for this audience is, you know, what happened on September the 15th last year when Lehman Brothers went bust was that the game shifted dramatically in your favor and away from the old system, but that to make the most of this opportunity, you need to be discontinuous in your thinking. You need to understand that you mustn't just keep doing the same old thing, but you need to really go back to first principles, and actually you'll find within your organizations all sorts of things that you didn't regard as particularly important, but that actually may be very, very valuable in this new world. I mean, I've thought a lot of this about Teach for America or Teach the World or whatever it's now called. You know, it is brilliant at figuring out which graduates that want to work for it are actually capable of working in some of these areas, and which would be completely useless. There's going to be a huge flood of people who are qualified who want to work in your sector now, and you know, you need to figure out which ones you want and which ones you don't want. And some of your organizations are very, very good at doing that, and how you share that knowledge amongst the community, for example, will be a make or break issue for whether you can really make the most of this great opportunity. So I think there's going to be all sorts of assets that you have in your organizations that you might overlook because you continue to think the old way rather than look through the fresh lens. So I think this is a great opportunity. I think the panel has been tremendously inspiring, so I'd like to thank them all.